Welcome back to Smart Stocks Sam, where we cut through the noise and get to what actually matters for your portfolio. Before we dive in, let me ask you something. If someone handed you a business that just posted its most efficient year in over a century of operation, record margins, record revenue per customer, earnings that crushed Wall Street's expectations by a wide margin, how much would you pay for it? Now, what if I told you the market's answer to that question was 64% less than it was worth 12 months ago? That is not a typo. That is AMC Entertainment in 2025. And today, we are going all in on the question that has divided investors, confused analysts, and made this one of the most debated tickers on the internet. Is AMC actually undervalued right now? Or is the market trying to warn us about something the income statement simply cannot show? We are walking through the post-earnings data, the institutional behavior, the premium strategy, the debt situation, all of it. Stay with me, because by the end of this video, you will have a real framework for thinking through this. Not hype, not fear, just the full picture. Let us start with the paradox that nobody in mainstream financial media wants to fully explain. In 2025, AMC Entertainment achieved something genuinely remarkable. In a year where most of the entertainment industry was scrambling, AMC quietly put together the best operational performance in their 100-plus year history. We are talking about all-time records across their most important efficiency metrics, revenue growth that outpaced the entire North American box office by a factor of more than 3, and EBITDA expansion that signaled a fundamentally transformed business model. And yet, and this is the part that should genuinely stop you in your tracks, the stock fell from $3.27 per share all the way down to $1.17, a 64% collapse in 12 months, while the business was winning, while the executives were setting records, while the operational story was getting better by almost every measurable standard. That is not normal market volatility. That is a full, complete, and total decoupling of business fundamentals from equity pricing. The company is running better than it ever has. The stock is priced like it might not survive. So which side is right, and which side is about to be very, very wrong? To answer that, we have to start with the actual numbers, the ones the analysts predicted, and the ones AMC actually delivered. In the fourth quarter of 2025, AMC walked into earnings season with the market braced for disappointment. Analysts had been cautious, modeling modest results and expecting meaningful losses at the per-share level. What they got instead was a demolition of their own estimates. Revenue came in at $1.288 billion, beating the street consensus by 1%. Now, 1% might not sound dramatic, but in a quarter where the broader box office was essentially flat, outperforming expectations on the top line is significant. The real headline, though, was on earnings per share. Wall Street had modeled a loss of up to 25 cents per share on an adjusted basis. AMC narrowed that loss to just 18 cents. That is a 28% beat. In any industry, in any market environment, a 28% earnings beat is an extraordinary result. And then came the number that professional analysts spend the most time watching, adjusted EBITDA. AMC reported $134 million, a full 10% above what the consensus had projected. The company did not just clear the bar, they raised it and then stepped over it. And here is the part that makes the operational story truly hard to ignore. All of this happened while total attendance remained below pre-pandemic levels. Fewer people in the seats, better financial results. That combination is not an accident. It is a strategy. And understanding that strategy is the key to understanding everything else that follows. The North American box office as a whole grew by a modest 1.5% over 2024. That is barely moving. In that same environment, AMC's revenue grew by nearly 5%. They are not growing at the pace of the industry. They are growing at more than 3 times the pace of the industry. Think about what that means structurally. AMC is not simply a passive beneficiary of whatever Hollywood decides to release. They are actively capturing a larger share of every dollar being spent on movie-going in North America. They are pulling audience away from competitors. They are monetizing that audience at a higher rate. And the result of doing both of those things simultaneously is showing up powerfully in their full-year profitability numbers. AMC grew their adjusted EBITDA from $343 million in 2024 to over $387 million in 2025, a 13% year-over-year increase in core cash generation. Management has effectively proven to the market, even if the market has not yet acknowledged it, that a 2019-sized audience is no longer required to produce 2019-sized results. They have rebuilt the engine while the car was still moving. So how exactly are they extracting more value from a smaller audience? The answer is a strategy they have been quietly executing for the past 2 years: value over volume. AMC has stopped optimizing for the number of people walking through their doors and started obsessing over what each of those people spends once they are inside. In 2025, they set all-time company records for admissions revenue per patron, food and beverage revenue per patron, and total revenue per patron, simultaneously across all 3 categories in the same fiscal year. That has never happened before in AMC's history. Every person who buys a ticket at an AMC today is worth more to the business than any customer at any point in the company's existence. And that is not because they are gouging people on popcorn prices. It is because they have fundamentally repositioned what the AMC experience is, and the anchor of that repositioning is premium. AMC has locked up the premium large format market in a way that competitors have not come close to matching. They currently control 56% of all IMAX screens in the United States. 56%. That is not a market advantage. That is a structural chokehold on the highest grossing, highest margin screen real estate in the country. And the performance data backs it up. AMC's premium screens are generating per-screen grosses that run 32% higher than their nearest competitor. When a film like Dune or Avatar or the next major franchise installment arrives in theaters, the seats that matter most, the ones where customers willingly pay a premium and drive across town specifically for the experience, the majority of those seats belong to AMC. That is a defensive moat built from technology, real estate, and brand positioning, and it compounds every single time a big film opens. To keep earning those premium prices, you need premium technology. AMC has now completed close to 3,000 laser projection installations across their circuit, and they accomplished it without blowing up their balance sheet. They used a cinema-as-a-service model, a capital-efficient upgrade framework that lowered lamp replacement costs, improved image quality dramatically, and extended the useful life of their projection infrastructure. It is exactly the kind of operational thinking that separates a company that is merely surviving from one that is genuinely evolving, and AMC is evolving far beyond the theater walls. They are diversifying their revenue model in ways the market has not fully priced in yet. Alternative content events, the Taylor Swift concert film, the Stranger Things finale theatrical experience, are filling calendar gaps that used to mean dark screens and zero revenue. They have launched Perfectly Popcorn, a branded retail product line now available in grocery stores, taking the most emotionally resonant part of the movie-going experience and turning it into a recurring consumer product. The Popcorn Pass subscription model is creating digital recurring revenue with zero marginal cost per activation. Taken together, these moves represent a genuine transformation. AMC is no longer simply a chain of movie theaters. It is becoming a diversified entertainment brand with multiple monetization channels, a recognizable consumer identity, and revenue streams that extend well beyond whatever Hollywood chooses to release on any given weekend. Now, all of that operational excellence means absolutely nothing if the company collapses under its debt. So let us talk about the moment that changed the survival narrative entirely. In July of 2025, AMC executed one of the most consequential financial moves in their recent history. They redeemed their 2026 debt maturities and refinanced the entire obligation, pushing the due dates all the way out to 2029 and 2030. In a single transaction, they eliminated the near-term existential threat that the short sellers and the bears had been pointing to for 2 years. There is no looming maturity wall. There is no bankruptcy cliff approaching in the next 18 months. The clock has been reset, and the conversation has officially, irreversibly shifted from survival to optimization. They have a multi-year runway to continue executing this higher margin pivot without the pressure of imminent refinancing risk. And yet, with the debt handled, the profits growing, the records being set, and the strategy working, the stock is still being absolutely punished. Why? Because the institutional money that drives long-term equity re-ratings is not buying the story, it is selling it. In the most recent quarter, institutional long positions in AMC dropped by more than 23%. 67 million shares were liquidated by professional money managers. The average portfolio weighting, how much conviction institutions are placing on AMC as a percentage of their total holdings, collapsed by 45%. These are not small adjustments. These are portfolio managers making a deliberate, documented decision to reduce their exposure to this stock, even as the business improves. And when you look at who is on the shareholder list, the picture becomes even more layered. The largest holders are passive index giants, Vanguard, BlackRock, firms that own AMC not because an analyst made a conviction call, but because AMC sits inside an index that they are required to track. Their presence on the cap table is mechanical, not discretionary. The active managers, the ones whose entire job is to decide which stocks to own, are the ones leaving. Citadel advisors cut their position by nearly half. Bank of America reduced their holding by 90%. And a set of prominent active managers, Covalent Partners, Pentwater Capital, Aristaya Capital, have gone to zero, full liquidation, no remaining position. When firms of that caliber exit completely, they are not making a trade, they are making a verdict. They are saying the operational story is real, but the equity story is broken, and those two things may never converge. On the other side, some specialized and smaller firms, like Peconic Partners, who increased their position by 50%, are making an aggressive contrarian bet that the gap between the business and the stock will eventually close. That tension between the exits and the entrances is exactly what makes AMC one of the most genuinely uncertain stories in the market right now. So as we look ahead into 2026, what is the honest framework for thinking about this? AMC sits at a crossroads that does not have a clean answer. On one side, you have an operationally transformed business, leaner, more efficient, more diversified, with a debt structure that no longer threatens its near-term existence, and a premium positioning strategy that is generating record revenue per customer and widening the gap between AMC and its competitors. On the other side, you have a stock that has lost 64% of its value in 12 months, with institutional money systematically reducing exposure and the most sophisticated active managers choosing to walk away entirely. The fundamental business recovery is running ahead of the equity valuation recovery, and that gap is where all of the risk and all of the potential reward lives simultaneously. If you believe the value over volume model will eventually force the market to re-rate the stock, that institutions will return when they see another year or two of consistent EBITDA growth, clean debt, and premium market share expansion, then the current price may represent one of the more compelling contrarian setups in the consumer entertainment space. But if you believe the institutional exodus reflects something deeper, a structural problem with the equity, whether it is share dilution from the meme era, persistent skepticism about long-term theatrical attendance trends, or simply a stock that has lost the trust of the professional community that moves markets, then the operational wins, impressive as they are, may never translate into a re-rating of the share price. Before we wrap up, something important that I want to be completely transparent about. Nothing in this video is financial advice. I am not a licensed financial advisor, and Smart Stock Sam is an educational channel designed to help you think through complex investment situations more clearly, not to tell you what to buy or sell. Every investment carries risk. Past performance, including AMC's impressive operational results, is never a guarantee of future returns. The stock market can remain disconnected from fundamentals for far longer than any of us expect. Always conduct your own research and always consult a qualified financial professional before making investment decisions with your real money. Here's the bottom line. AMC in 2026 is a genuine battleground, and battlegrounds are uncomfortable, messy, and full of uncertainty by definition. The bears have institutional momentum, structural skepticism, and a 64% price decline working in their favor. The bulls have record EBITDA, a clear debt runway, premium market dominance, and a business that is outperforming the industry by a factor of more than 3 working in theirs. Somewhere in that tension is either the setup of the year or one of the most instructive lessons the market will hand out in 2026. Here at Smart Stock Sam, we do not pick sides. We build the framework, lay out the evidence, and trust you to think for yourself. That is the whole point. Stay sharp, stay curious, and we will see you in